During 1929, equity valuations collapsed catastrophically, obliterating 89% of market worth across 3 years. Employment reached devastating 25% unemployment rates. Financial institutions shuttered. Accumulated household savings evaporated entirely. 2.5 decades elapsed before valuations recovered toward 1929 baseline levels. Throughout 2008, residential real estate valuations deteriorated precipitously, devastating economic security. Equity indices declined 57% within 18 months. Joblessness affected 10% of workforce populations. Financial institutions required governmental rescue. Retirement portfolios experienced severe impairment. 5-year recovery periods restored market equilibrium. Yet contemporary 2025 circumstances diverge fundamentally from historical precedent. Simultaneously, equities, bonds, and real property valuations are experiencing coordinated collapse. Financial historians designate this occurrence the everything bubble. When every asset category declines synchronously, portfolio diversification provides zero protection mechanism, capital has nowhere to reposition for safety. This represents unprecedented financial architecture because governmental intervention tools that rescued economies post-1929 and post-2008 have been exhausted. The Federal Reserve cannot reduce interest rates toward zero. Existing rates already approximate historical minimums. Unlimited monetary expansion becomes impossible because recent currency debasement triggered 40-year inflation peaks. Governmental bailout mechanisms cannot function because national indebtedness already exceeds $36 trillion magnitude. Consider this interrogative. Might we be inhabiting 1928 immediately preceding Depression emergence? Except contemporary circumstances prove substantially deteriorated because policy mechanisms have become inoperative. Contemporary financial markets don't experience singular bubble phenomena. Rather, 3 simultaneous bubble conditions exist simultaneously, an occurrence absent from recorded financial chronology. Examine equity market conditions initially. The S&P 500 maintains price-to-earnings multiples approximating 28, representing nearly double historical normal ranges between 15 to 17 parameters. Comparable overvaluation materialized exclusively during 2 prior instances: 1929 immediately preceding Depression genesis, and 2000 immediately preceding Internet bubble deterioration, destroying 78% of NASDAQ valuations. Both circumstances preceded market collapses materializing within months of achieving valuation extremes. Yet 2025's concentration risk amplifies danger substantially beyond 1929 or 2000 magnitudes. 7 corporations, Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, Tesla, constitute approximately 30% of comprehensive S&P 500 capitalization. Should these 7 enterprises experience valuation declines, aggregate market indexes contract correspondingly. This concentration magnitude remained unobserved since 1929, when industrial stocks represented equivalent market dominance immediately preceding collapse. Nvidia particularly exemplifies contemporary valuation insanity, trading at price-to-earnings multiples exceeding 65. Institutional investors compensate $65 for every dollar enterprise profitability generation. Nvidia's aggregate market worth surpasses $3 trillion, exceeding Germany's comprehensive stock market valuation, the world's 4th largest economy. This represents pure speculation, driven by artificial intelligence enthusiasm, mirroring 1999's Internet euphoria. Now here's where this becomes controversial. Certain analysts contend that revolutionary technologies justify temporary valuation premiums during adoption phases. Others insist current AI-driven valuations represent disconnection from fundamental economics. I conceptually align with the latter perspective, because price-to-earnings ratios exceeding 65 eliminate any rational justification mechanism. But I want to hear from you. Drop a comment. Can technology enthusiasm justify contemporary equity valuations, or have markets completely disconnected from financial fundamentals? The evidence could support either interpretation. Let's debate what you genuinely believe. The residential real estate sector constitutes a second bubble dimension, demonstrating even more extreme overvaluation than 2008's housing catastrophe that necessitated global financial system rescue. During November 2025, residential property valuations approximate 50% elevation above long-term historical trends, accounting for income and rental equivalencies. Peak 2008 bubble conditions demonstrated 35% elevation. Contemporary housing bubble magnitude exceeds 2008's destructive bubble by 43% percentage points. Contemplate this magnitude. The financial crisis demanding trillions in stabilization and nearly destroying capitalism represented merely 35% overvaluation. Contemporary conditions manifest 50% overvaluation. Remarkably, most populations remain unaware. Bubbles exist because extended periods of elevated valuations establish psychological normalcy. Commercial real estate encompasses supplementary deterioration dimension. Workplace facilities demonstrate 45% vacancy prevalence as permanent remote employment paradigms become established. San Francisco specifically experiences 35% commercial office space vacancy. These structures carry mortgage obligations established when interest rates approximated 3% levels. Refinancing necessities now require rate compensation between 7 to 9% magnitudes. Properties couldn't generate adequate revenue supporting 3% debt service. They're mathematically insolvent under triple-rate conditions. Defaults inevitably follow, triggering institutional bank deterioration and cascade failures mirroring 2008's residential crisis, except affecting commercial property instead, the third bubble. And this fundamentally distinguishes 2025, encompasses government bonds. Treasury securities traditionally function as stability mechanisms during equity turbulence. During 1929, bonds maintained security despite stocks declining 89%. Throughout 2008, Treasury instruments appreciated as investors fled equities toward putatively safe mechanisms. Conversely, 2025 bonds deteriorate alongside equities because governmental borrowing has become unsustainable. Federal indebtedness surpasses $36 trillion, approximately 125% of GDP, matching post-World War II American leverage ratios. Yet, contemporary America faces competition from economically stronger nations, unlike post-World War II circumstances when America remained the sole major economy, avoiding warfare devastation. Interest payments on accumulated debt exceed $1.2 trillion annually, the single largest federal budget allocation, surpassing defense expenditure and Social Security disbursements combined. Governmental circumstances now present three exclusive alternatives: slash spending drastically, triggering recession; increase taxation sharply, triggering recession; or monetize debt through currency expansion, triggering inflation. Every pathway leads to catastrophic consequences. The correspondence between contemporary 2025 conditions and 1929 circumstances demonstrates precision, suggesting historical recurrence patterns. During 1929, equity valuations achieved extremes. The Dow Jones Industrial Average Price-to-Earnings multiple reached 33, dramatically surpassing historical norms. Contemporary S&P 500 demonstrates comparable magnitudes at 28 multiples. The 1929 population embraced beliefs that technological innovations had fundamentally altered economic fundamentals, establishing permanent new paradigms where traditional valuation methodology no longer applied. This time proves different. Represented constantly repeated 1929 rhetoric. Contemporary 2025 exhibits identical narrative regarding artificial intelligence, supposedly transcending historical valuation frameworks. The market is pricing in 10 years of perfect AI adoption into today's stock price, leaving zero margin for error. During 1929, margin debt capital borrowed exclusively for equity acquisition achieved unprecedented magnitudes as populations leveraged themselves, pursuing wealth accumulation. Comparable dynamics manifest in 2025. Margin debt proportional to GDP achieves 1929 equivalence, yet modern leverage transcends traditional margin mechanisms. Retail investors deploy options trading, 0 DTE, 0 days to expiration options. Credit card borrowing, corporate share repurchase leverage. Contemporary financial architecture contains leverage everywhere embedded within derivatives, option structures, and credit arrangements most populations incompletely comprehend. The notional value of derivatives globally is estimated at over $1 quadrillion. Income concentration during 1929 achieved extremes where the wealthiest 1% maintained approximately 25% of aggregate income. Contemporary 2025 demonstrates even heightened inequality. The wealthiest 1% presently controls approximately 32% of aggregate wealth. Economies depend upon the top 10%, controlling 70% of consumer expenditure. This creates a hollow economy. Critically, 2025 diverges disadvantageously from 1929 because participation ranges dramatically expanded. During 1929, merely 10% of households possessed equity positions. Contemporary periods witness approximately 58% of American households maintaining equity ownership, either immediate or through retirement instruments. Market collapses directly devastate retirement security for majorities of population. The democratization of finance has become the democratization of risk. During 2008's crisis genesis, subprime mortgage instruments loans extended to borrowers maintaining insufficient repayment capacity were transformed into complex financial products and distributed globally. Housing price appreciation cessation prevented refinancing for defaulting borrowers. Cascading defaults revealed that institutions maintained excessive leverage concentrations and possessed valueless mortgage-backed securities. Banks like Lehman Brothers demonstrated 30-to-1 leverage ratios. 30 asset value for every 1 capital. 3% asset deterioration obliterated equity positions entirely. Contemporary 2025 features ubiquitous subprime lending terminology simply disguises the mechanism. Automobile credit extends through 84-month periods at elevated rates toward credit-impaired populations. Credit card obligations achieve historical peaks with 21 to 28% interest compensation rates. Student debt accumulation reaches $1.77 trillion involving 43 million borrowers who will never achieve complete repayment. Corporate debt quintupled from $2 trillion, 2008, toward exceeding $10 trillion through cheap-rate borrowing financing share repurchase mechanisms. Leverage concentrates everywhere throughout contemporary financial systems. During 2008, Federal Reserve officials possessed powerful intervention mechanisms. Interest rates approximated 5.25% commencement levels, permitting reduction toward zero levels. This stimulated borrowing and spending, stabilizing economic conditions. The Fed could simultaneously implement quantitative easing, purchasing treasury bonds and mortgage instruments, injecting capital into financial systems. Federal Reserve balance sheets expanded from $800 billion pre-crisis toward $4 trillion by 2014. Extraordinary currency expansion assisted collapse prevention, despite establishing contemporary bubble conditions. Federal Reserve balance sheets expanded from $800 billion pre-crisis toward $4 trillion by 2014. Extraordinary currency expansion assisted collapse prevention. Despite establishing contemporary bubble conditions, contemporary 2025 interest rates already approximate historical minimums, providing minimal reduction capacity. Rate reductions threaten inflation recurrence, requiring recent painful compression mechanisms. Quantitative easing faces similarly constrained circumstances. Federal Reserve balance sheets exceed $7 trillion following post-2008 and pandemic expansion periods. Unlimited currency expansion faces similarly constrained circumstances. Federal Reserve balance sheets exceed $7 trillion following post-2008 and pandemic expansion periods. Unlimited currency expansion became conceptually comprehensible regarding inflation implications through 2021 to 2023's worst 40-year inflation surge. Contemporary expansion capacity remains theoretically available but politically and economically constrained. If you've experienced inflation consequences affecting purchasing power, Federal Reserve officials confront genuine traps. Currency expansion ignites inflation, threatening dollar functionality. Restraint permits depression magnitude economic contraction. Balanced pathways no longer exist because policy intervention mechanisms have become exhausted through repeated application. Governmental bailout capacities similarly deteriorated. During 2008, governments possessed borrowing capacity financing bank rescue mechanisms. Drop a comment. Your experience matters because 2021 to 2023 inflation demonstrated that unlimited money printing destroys currency function. Federal debt approximated 67% of GDP manageable by historical standards. The Troubled Asset Relief Program authorized $700 billion for purchasing toxic assets. Aggregate rescue programs approached $2 trillion expenditure. Governmental borrowing capacity enabled stabilization despite political unpopularity. Contemporary 2025 conditions demonstrate $36 trillion in indebtedness at 125% GDP ratio, with perpetual trillion-dollar deficits. Governments lack additional $2 trillion for corporate and banking rescue. Attempted borrowing triggers bond market rejection, elevating interest rates further, making debt sustainability even more problematic. The 2008 bailout mechanism governmental rescue capital has become mathematically impossible. 12 specific financial indicators have historically preceded major market declines. Contemporary 2025 demonstrates all 12 simultaneously activating. The inverted yield curve represents most reliable recessional predictor. The yield curve inverted during July 2022, remaining inverted through 27 months until September 2024. Normalization historical analysis demonstrates that recessions typically commence 3 to 12 months, following yield curve normalization. This positions danger windows between October 2024 and September 2025. Consumer credit has achieved unprecedented extremes. Credit card indebtedness surpasses $1.14 trillion at all-time records. Delinquencies, representing 90 days plus payment, delinquencies have reached 2011-era maximums. Commercial real estate demonstrates accelerating deterioration. Approximately $2 trillion in commercial mortgages require refinancing through 2025 to 2026. Properties financed during 3% interest periods become mathematically insolvent at contemporary 7 to 9% rates. Insider equity sales have achieved historical maximums. Corporate leadership possesses information ordinary investors lack. When executives liquidate substantial personal holdings, valuations demonstrate unsustainability. Warren Buffett maintains $325 billion cash positions historically maximum levels. His valuation metric dividing aggregate stock market capitalization by GDP registers 185%. Unemployment directions demonstrate rising trajectories from early 2023 3.4% minimums toward October 2025. 4.1% levels. The SAM rule criterion has predicted every recession since 1970. Without false indicators, automobile lending demonstrates concerning deterioration. Approximately 7.5% of auto loans demonstrate 90 days plus delinquencies highest levels since 2009. Student loan delinquencies surge since October 2023. Payment resumption. Accumulated student indebtedness reaches $1.77 trillion. Geopolitical risks amplify uncertainty dramatically. Ongoing conflicts, invasion potentials, and trade fragmentation create conflict escalation possibilities. Commercial real estate defaults begin materializing among institutional possessors. Credit card delinquencies have begun rising toward 2011-era maximums despite economic growth theoretically continuing. Margin debt approaches 1,929 proportions. Contemporary leverage exists everywhere. Derivatives, options, corporate share repurchases, cryptocurrency platforms. Collapse commencement won't announce itself through universally recognized trigger events. Systems demonstrate sufficient fragility that minimal shocks commence uncontrollable deterioration. When NVIDIA or alternative Magnificent 7 enterprises disappoint earnings expectations or signal weak forward guidance, algorithmic trading mechanisms trigger instantaneous selling. Daily single-stock declines could reach 10 to 15%. Within days, Magnificent 7 positions could decline 20 to 30%, reducing comprehensive indexes 6 to 9%. This triggers margin calls. Margin calls represent downward spiral accelerants, transforming declines into crashes. Forced liquidations drive prices lower, triggering supplementary margin calls. Uncontrollable downward spirals materialize. Institutional investors managing trillions operate according to risk management protocols requiring selling during threshold-crossing market declines. These represent automated mechanisms. Initial crash months could witness 30 to 40% stock index declines through synchronized retail panic selling, margin call cascades, and institutional risk management protocols. Crisis expansion extends toward bonds as investors pursue theoretical safety. Yet, 2025 Treasury instruments lack security characteristics because governments require massive supplementary borrowing during simultaneous crisis periods. Housing markets freeze when purchaser populations disappear. 6-month price reductions of 20 to 30% become realistic. 12-month declines of 40 to 50% manifest in overvalued regions. Commercial real estate defaults accelerate when proprietors recognize refinancing impossibility. Lending institutions, typically regional banks, take possession of properties worth 40 to 60% below loan amounts. Bank failures cascade. 2008 demonstrated 465 institutional failures across 5 years. Forthcoming crises could demonstrate equivalent or superior numbers concentrated within abbreviated periods. Federal Deposit Insurance Corporation guarantees cover deposits to $250,000 thresholds. The $125 billion insurance fund becomes laughably inadequate during multiple major institutional failures. Governmental currency expansion becomes mandatory for depositor reimbursement. Employment collapses when enterprises confronting revenue declines. Execute cost reductions through workforce elimination. 3 months post-crash commencement, unemployment could escalate from 4% toward 7 to 8%. 6 months generates 10% plausibility. The Federal Reserve confronts impossible alternatives. Interest rate reductions combined with quantitative easing attempt market stabilization. Yet, this resurrects inflation concerns. Alternatively, policy restraint permits depression-magnitude economic contraction. No intermediary pathways exist for typical Americans holding 401k and IRA accounts. Observing retirement accumulations decline 60 to 70% creates devastation. Extended labor participation becomes necessary. Retired populations dependent upon portfolio withdrawals experience catastrophic situations. Forced asset liquidation at depressed prices finances living expenditures, locking in losses never recovering. Employment market conditions for young workforce entrants become brutal. Career commencements delay 5 to 10 years behind normative timelines. Lifetime earnings suppress significantly. Small enterprise catastrophe materializes when consumer spending collapses and credit availability disappears. Aggregate economic dominance concentrates further within massive corporations. Social safety net systems face strain beyond capacity when unemployment accelerates and tax revenues collapse. Political instability follows economic collapse historically. Complete loss populations pursue blame attribution and radical solution seekers, so Y represents 2025 as worse than 1929 to 2008 combinations. Triple simultaneous bubbles materialize. During 2025, everything crashes together, while policy mechanisms have become inoperative. The everything bubble earned nomenclature precisely because everything simultaneously crashes with nowhere remaining for protective positioning. The mathematics of unpayable debt, overvalued assets, and exhausted policy interventions guarantees collapse.